It's a pleasure to extend a warm welcome to each one of you at the beginning of the second day of the CII 20th Global Sustainability Summit. Delegates, you can access all summit-related information by scanning the QR code on your badge. We will be beginning with the first session of the day, From Ambition to Action, Building the Ecosystem for Business Sustainability. This session brings together regulators, investors, and industry leaders to explore the evolving ecosystem for transformative sustainability action. To lead and commence the discussion, we warmly invite the moderator, Mr. Rajat Gupta, Senior Partner, McKinsey & Company, to the dais. We also request the panel members, Mr. Sean Kingsbury, Mr. Rajneesh Kumar, and Professor Amit Garg to join the moderator on the dais. Mr. Gupta, I hand it over to you to take the session forward.
Good morning, and thank you for being here this early for the first panel of the day. Let me begin with a quick round of introductions and then lay a little bit of the context for today's discussion. So I'm Rajat Gupta, part of McKinsey's founding class in India. Over the last 3 decades that I've been here, I've built our energy and materials practices in Asia, and also, to pay for my sins, the sustainability practices. We have here on the panel Professor Amit Garg. He's from IIM Ahmedabad, part of the public systems group there, very deep in disclosures and other elements that we will discuss, which form the base of the ecosystem that is a subject of today's discussion. And he's also the ESG chair for NIF. Welcome. We have Mr. Rajneesh Kumar, who needs no introduction, the ex-chairman of SBI. We have Mr. Sean Kingsbury. He's the founding partner and chief investment officer of Just Climate. It's a $2 billion climate specialist fund, including investments in India in a power platform called Continuum Energy, and in a hard-to-abate sector, H2 Green Steel, which is now called Stegra. Prior to this, he was the ex-CEO of UK Green Investment Bank, which was a government entity to start with, a £3 billion government fund to leverage 5x as much private capital into climate. I'm sure there'll be lessons to be learned from both his sets of experiences. With that, let me quickly set the context and then jump into the discussion. So let me just start by saying that in India, at least my belief is that this is not a decarbonization story, right? In fact, decarbonization is perhaps a Western word appropriate for there. For us, it is really an issue of building right and building decarbonized, right, as opposed to decarbonizing history, right? And why is that? Because 75% of India of 2050 hasn't been built yet. 75% of our steel plants haven't been built, 70%, 75% or 80% of our car park hasn't, the transportation base hasn't arrived, infrastructure hasn't been built, housing stock hasn't been built. And all of this will happen, a lot of this will happen in the next 10, 15 years, right? Which is an opportunity and a challenge. The opportunity is, since we haven't built, we can build right. The challenge side of it are 3 or 4 issues that we have to keep in mind. I think the first is, if we have to build right in the next 10, 15 years, where a lot of this stock of industrial, urban infrastructure investment will come, then we have to act today, and we have to act at pace very fast, in an accelerated manner. And we have to get green investments in now at scale. So that's point number 1, I think, which is a complication. The second complication, not complication, second factoid around this is that a third of the investment maybe, but certainly the decarbonization, or I mean, using that word nevertheless, opportunity or future decarbonization opportunities in power, where there's a lot of action. About a third is in the industrial sector, steel, cement, refining, lime. These are the main sectors. A fifth is agri, largely bovine emissions and rice, and fertilizers to some extent. About a tenth is transportation. right? All kinds, freight and, so it's few sectors, which is probably a bit of the good news, but also these are very complicated sectors by themselves. I think the third point I'll make at a macro level is that there are new technologies, of course, for green steel, as we will hear, for green power, as we know, for green mobility, as we are seeing, alternate cementitious materials, etc. But it also needs a fundamentally new approach, densification of urban agglomerations or cities that we build. Densification means more energy efficient use, right? Even though the capital investment for that is higher, right? If you densify, you build tall, more capital expenditure, but less operating energy expenditure overall. A modal shift to railways or electrified transport, for example. Right? These are, so besides technologies, it's also a fundamentally new planning approach that's needed. And these end up being more capital intensive. Right? So green technologies, generally, I would say, OpEx is substituted for CapEx. So coal plants have equivalent OpEx and CapEx in the 4 or 5 rupee power that they might generate, or 4 rupee power that they might generate, while a solar plant is 95% CapEx, only 5% OpEx. Right? So OpEx is substituted by CapEx, which means that higher investments have to be made earlier. Right? So our estimate as McKinsey is that we need to invest about 3.5 to 6% of our GDP in a 25-odd-year period to 2050, $7 to $12 trillion. In this decade, we have to quadruple the investment. So we invest about $40–50 billion. We have to invest about 160 a year. Right? In the next decade, we have to quadruple again. Right? So about $440 billion every year next decade, right? In green investments. So large amounts of investments. So these are all the complexities in building India right. Now, there's also project or technological complexities. So projects that we will also come back and talk about are, at least I see them of somewhat oversimplified to 3 types, right? So there are those which are not in the money because the technology isn't quite there. CCS is an example of that. Partly it's technology, partly we haven't explored India for where we can push the carbon dioxide underground, right? Some elements of textile recycling and separation, right? Where you have blended fabrics, right? Which have to be separated. Not a technology that's out there that's anywhere close to ready. So this is the first type of projects. The second type of project, and these have to be done because those technologies have to get ready. It's a little bit like solar was 25 years ago. Second is where the technology is ready, but the outcome is substantially more expensive than gray alternatives. An example of that is green hydrogen, where we've seen a lot of movement in the last month actually, with the CII auctions having been successful. There's green steel, which we'll talk about, green aluminum, nuclear, 10 or 12 rupee power relative to 4 or 5 rupee coal power. And so here you need regulatory support, like CII has provided historically for solar, now for green hydrogen. But it needs things like blending mandates, carbon pricing, direct subsidies, again, something that we'll, I'm sure, touch on in the course of this discussion. And of course, it needs continued technology development to get the cost down. And industrial scaling, because that's what got China's solar cost down. It was technology, IP, plus industrial level scaling. And then there is the third set of projects which are viable, electric mobility, very viable. But again, the capital expenditure is advanced, so it needs financing solutions, for example. Or grid management, power generation with infirm sources of power like renewables, plus the grid stabilization, which is still quite expensive, right? More than coal would be. So those solutions are viable, but need scaling. And if there's lower cost of capital and more capital available, they'll scale faster. Also more entrepreneurs. So these are the 3 types of projects: not ready, ready with regulatory support, and starting to scale. And then the ones that can scale and are scaling also, I might say. But are they scaling enough is the question I will raise, and what role can financing play against that? So with that discussion, what I'd like to do today is to bring out some of the thinking that all the members here, including myself, all the people here, including myself, are a part of the CII India Sustainability Task Force. And that group has been thinking about enablers that are needed for finance to come together at scale and at lower cost, right? So that's a little bit of where the discussion will go with a little bit of the framing that I've done. Maybe let me start with turning to Rajneeshji. My question to you is that at SBI, how did financing for green projects work? How is it working now? I know you've retired 5 years ago, but I'm sure you're in touch with them. What were the challenges? Did you break through these challenges? Can you give us a few examples and stories of this?
Yeah, thank you, Rajat. There are questions within question. So it is not one question, there are many questions, but State Bank of India, it was the first bank in the country to set up a project finance unit in 1988. And the other two institutions which were active were ICII and IDBI, which were doing project financing as well as financing to industries and providing the term capital. So green is a label. Project finance is project finance. And when you add green, then there may be some additional risks which you were mentioning. So the appraisal of the projects, it remains the same. Some of the issues when it comes to the green projects was about the parity. For example, I will take again an example of power sector. So there is thermal power and there is solar power. So at one point of time, the cost of power produced was 12 or 13 rupees. And somebody has to pay for that power. So who will pay? So consumer, obviously, and consumer, if through thermal they pay 2.5 rupees per unit at that time and you compare it with 12. So this is a big challenge, that from whom you will recover. And then as things develop, the cost of solar power almost became equal to the thermal power. But then what happened that sometimes in their anxiety to bid for the projects, so many companies went overboard. So one problem which banks always encounter is the enthusiasm of the promoters also. And they try to play on the capital or leverage, that I put 10%, 15%, you put 85%, so that they can generate return on equity, and then the risks which are associated, ignore those risks. So these are some of the individual challenges which come in, but specifically about the collaboration with multilateral institutions. So State Bank, we did a tie-up with World Bank for financing solar rooftop. The desire was that we bring down the cost of funding. But when we started working, there was no way the funding cost could come down, because World Bank warranty, government guarantee. Government says if I give guarantee, then I charge guarantee premium to you. So this was, I find it very funny that World Bank needed State Bank of India to give government guarantee. I can raise money at a cheaper cost on my own strength as a State Bank of India. But here is a multilateral institution which wants to give funding. The stated objective is we should bring down the cost. But then when it comes that I have to give government guarantee, then at government guarantee cost, then at hedging cost, and it doesn't work out to be cheaper than rupee funding cost for any promote. But apart from the funding cost, this was a very successful program, let me tell you. In terms of implementation, in terms of execution, in terms of risk assessment by State Bank of India. The only problem which we could not solve was about how do we make it cheaper for the portfolio.
Hopefully this panel will solve that problem later on. I know it's a beastly complex problem for a variety of reasons as you described it, right? I mean, there is the inherently higher risk, there is the question of currency in India, there is the unfamiliarity of both bankers, which we'll also come back to, right, of how do you actually assess the risk, and there, particularly if there isn't as much track record in these areas, unlike for thermal power or cement plants or whatever else that you have to fund. Maybe Rajneeshji, let me just continue. You talked a little bit about the history of what you did in SBI, or what SBI has done. As you look forward for funding for the kinds of things that I talked about, where do you see the pinch points? Are we short of projects? Are we short of funding? And if we are short of funding, what's the catch? What's the pinch point here?
A country like India, it needs capital. So there is, I mean, absolutely no doubt about it that we need capital to invest. Capital on the debt side, I don't see as much an issue, honestly. Equity side, we are very short. And we need lot of equity capital. The promoters also don't have that kind of capital. If we leave aside certain very large industrial houses or large companies, but India, which is a country of 145 crore people, and there are medium size, small size, various type of entrepreneurs and projects of different size. They don't have equity capital to put. A bank would typically, or a lender would typically say that you need to bring in, say, 25 to 30% of your own equity. And it has been my experience as a banker that they don't have that capital, and sometimes we have seen in the past is that there was camouflage. The bank capital, they did not have their equity capital, but through padding up the project costs and all that, it was ultimately the bank capital which became partly the equity capital. So if we really want the investment to go up by the private sector, we have to find equity capital and capital of different types, which has the capability to take risk. Obviously, it will come with a higher reward. There may be many, and if we talk to, say, somebody, an entrepreneur, a young man, he wants to put a, say, biomass production plant, and he needs, say, 10 crore. I'm telling you today, he will not be able to mobilize bank funding. That is the reality. He will have to run pillar to post. And banks have their own reason. The one reason is, apart from that, whether the project will be viable, whether he will be able to sell. The other is about the equity. For it, suppose a 10 crore project, if you expect that he will bring 2.5 crore, and if he's a young entrepreneur, from where will that equity come? So there is no dearth of ideas, there is no dearth of projects, there is no dearth of need for projects. There are so many initiatives, it is mind-boggling. But the real challenge, real issue is about understanding the risks, who underwrites the risks, and who provides the risk capital. That capital is, I don't think, as much an issue today. I think time to time situations may change, but even the banks, they have sufficient flow of money coming in to them. They need projects to deploy that money.
So interesting perspective. You're saying projects are not short. Debt capital in a traditional sense is not short, but equity we are short, and then maybe there's a risk capital which is somewhere between debt and equity, which is also short. So let's come back to some of this in a moment. Maybe I'll just use this opportunity to turn to you, Sean, and go back to your previous job at the UK Green Investment Bank, which you started, as I understand. And what was the thinking behind getting it going from a government perspective? What are the things that you did to unlock private investment, private capital, particularly if you did anything on the equity front? It'd be interesting to hear that.
I think, well, first of all, thank you for the kind invite to come and speak today. It's a delight to be here and to speak to you all. I'm particularly happy to be on the panel that's talking about action. That's really important. The UK was reasonably successful in decarbonising. When you look at where it's come since the base of 1990, we have taken about 50% of the emissions out, while more than doubling the size of GDP in the economy. So it's been reasonably successful at doing that. And in order to do that, it put in place a number of frameworks, things that were really important to set the tone that enabled mostly the private sector to come in and provide the capital. The first thing that it put in place, and I think it was the first country to do it, was an independent arm's-length body called the Committee on Climate Change. This was established by the government. It's populated with economists, and their job is to figure out and to look forward and to say, if we're committed to a net zero world by 2050 in the UK, what are the budget processes and what are the interim targets that we must hit to get on that pathway to decarbonisation? Every 5 years actually, they produce a new carbon budget, and they report independently, so they can't be interfered with by the politicians, on how we're doing. And we've hit each of those carbon budgets. But it gives a very clear, long-dated pathway. It talks about the different technologies, industry, transport, etc., and what they must do, sector by sector, to give a clear message to those of us who are investing. The second thing that they rolled out at scale to decarbonize the power market, because a key part of this program is to electrify everything with renewable energy, was to switch from feed-in tariffs to contracts for differences. Whenever you increase the cost of power, it's effectively a tax on your citizens because everybody needs to buy power. And so making sure that you have the most efficient system, and with a contract for differences, you have each of the technologies, onshore wind, offshore wind, solar, batteries, compete to provide the lowest possible cost, and you lock that in. When the power market is below that cost, the government steps in and socializes that cost so that it brings it up. But when the power markets are more expensive, the additional revenue that each of these projects makes gets paid back, so that over a period of time, this should all average out. And while that cost is socialized, you believe it's done at the best possible cost to consumers. Effectively, it's a tax on your population. And then the final thing we did about 10 years ago is we created the Green Investment Bank. It was the world's first green investment bank, and its job was to focus on what were then the hard areas, the hard to abate areas at the time. Technologies were different, things hadn't developed as well as they are today, and to crowd in private capital. To operate with the backing of government, in fact, they provided us with £3.8 billion, about $5 billion. That was the best funded startup I've ever done. And to deploy that capital fully commercially, it's fully caffeinated investing. There's no form of concessional finance in that. And to work to provide security and credibility with private investors and crowd that private money in. The key thing was to work in the areas which were short of capital, to crowd in capital, not crowd out capital by doing the work that private capital would do. We invested in the 5 years that we had the bank, we invested about $15 billion working with private capital. For every £1 we invested, we had £3 of private capital, so we were providing about 25% of the total stack. And then the final bit I would just mention, which maybe I'll hand back because I think we might talk about that over the next questions, is getting the carbon markets and the taxonomy right so that everyone understood what the definition of green would be.
Just a word or two also, Sean, on when you crowded in the private capital, what were the mechanisms that worked? And what were the mechanisms that didn't work?
So we invested our money, and we acted independently at arm's length from government as a commercial investor. So we didn't provide any guarantees. In fact, we usually invested alongside other people. And in theory, we were asked to do the deals that nobody else wanted to do. Now, usually when you do the deals that nobody else wants to do, that ends up badly. That ends up usually very badly. But it didn't in our case, because we found that this group of investment opportunities that were really good investment opportunities, but they weren't being fulfilled. People were not providing the capital. And it's a bit like the joke of the two economists walking down the road, and one says there's $20, and the other says, no, there isn't, or someone would have picked it up. In this case, people weren't picking up these investment opportunities. They were literally sitting by the side of the road, unfunded. And in retrospect, so we funded them. We provided capital. We didn't provide it in any concessional form. We usually invested with other people, filling the gap, making the same returns, taking the same risks, deploying capital at the same time. But I guess it provided people with a sense of security around that. They're investing alongside the government. And in retrospect, when I look back, there was a gap that we were funding, and that gap wasn't a shortage of money. We were based in the City of London, one of the best financing and probably with the best green financing location in the world. So how did we find 100 different projects that no one wanted to invest in? And the key thing that I guess in retrospect I learned was that money comes in buckets. It comes in risk buckets. And those buckets don't typically, aren't in the right format to fund many of the climate issues. Because you can't decarbonize energy, and you can't decarbonize steel, for example, with an app, right? You have to build real steel plants, you have to build wind turbines, you have to build solar facilities. And the ticket sizes are too big for venture capital. These projects are typically too asset heavy for growth capital. And because you're doing things in the early stages, they're not really infrastructure capital. So they fall between the traditional risk buckets of banks and investors. And what we did is we had flexible capital. We got up in the morning and we decided we were going to solve these problems, solve them commercially, solve them in a way that created a marketplace. And I guess we created a business model. When you look at what we did, yes, we made $15 billion of investments in the UK, but the UK is small. It's 1% of global carbon emissions. It's tiny. That's not what mattered. What really mattered is we created a model, a business model that has been admired and copied around the world. And as we think of the challenges that you outlined in your opening statement, of the amount of money that needs to become, we heard that equity capital in particular is short. Then is there an opportunity to create a green financing institution here in India that can try to provide some of that equity capital on a fully commercial basis that would fill those gaps and provide confidence for foreign direct investors, people like the business we have now, Just Climate, to come to India and invest alongside filling those gaps, solving those problems with flexible capital that fills what has become known as the missing middle. That's how I would describe that. So,
from the sound of it, it sounds like a venture infrastructure effort, right? A bit of a category defining effort. And obviously, there must have been huge amounts of capability that backed the origination of such projects and the risk assessment of such projects, right? So that's what it sounds like to me, without concessional capital. Now, I think that's relevant for India, but maybe there is an element of further risk reduction or further concessions, because the cost of equity, all said and done, at least foreign equity in India, still is in the range of somewhere between 18 and 25%, depending on who you talk to for these kinds of projects, right? Which some will make many of these unaffordable. At a financial center like the UK, that may not have been an issue. So I can see part of the solution in what you said, but I think we may have to explore beyond. Now, you also mentioned a couple of other different areas, the Green Investment Bank I'll come back to. But the point about taxonomy, nomenclature, disclosures. So maybe with that, let me turn to you, Amit. My first question to you is that for a layperson like me on this topic, to get these projects funded at low cost, at scale. Why is taxonomy and disclosure important?
Yeah.
Let's start there.
Yeah, thank you very much for having me here. Taxonomies are provided by countries. We have studied for 40 countries, including EU as a group, ASEAN, Singapore, UK, and of course India's draft taxonomy is also there. So, in my opinion, taxonomies they give insight on government's priorities for the future. Where we want to go, where we should be going, government's priority for energy security, for climate security, for creating confidence in the investors, for creating confidence in the industry, and providing a assurance to everybody that policy is here to have a continuance. So I think that is very important, because if this sort of thing is not there in the market, everybody will be a little shaky. We need to give assurance. We need to there that this is going to be a long-term trend in us. So this is the first point. Of course, there are, I'll wait for you to ask the second question. I don't want to, yes.
No, so I guess what you're saying is it forms the core of the basic, it communicates a strategy, is what I'm hearing you say, right? So, look, India does have a net zero goal, 2070, we've announced that. We do have a short-term goal, 2030, there's a set of goals that we've put in place. We do have policies in specific sectors to build green, right? In power, it's clear, and in ethanol blending for transportation, surface transportation, 20%. It's clear, and a bunch of other sectors. We do have some taxonomy from SEBI, is my understanding. Are there still gaps?
Yes, so that is a very good question. There are about 7-8 different genres of technology. Started 20 years back with GRI giving that this is how the disclosure has to happen. And then there is BRSR, which is the government of India, SEBI has given that. And there is a net zero target, so definitely there are gaps, because BRSR wants all the 1,000 companies, the big companies, to provide about 140 indicators every year. These indicators could be like environmental, social, corporate governance, 140 indicators have to be provided. Now, many companies are reporting this, but there are some indicators that are reported by more than 90% of companies. So in my opinion, they are good indicators that everybody can easily do that. There are some indicators which are only reported by 20% of companies. So we have to work on those. So this is something which is required. And net zero 2070, in my opinion, is a vision. Vision for the country to become climate compliant and take care of the world's challenges, global challenges. That is our vision. Now, if we want to take into our 2030 priorities, 2035, 2040, up to 2070. So it means we have to have decadal or 5-year slots for what should India be doing, what sectors to be promoted, not promoted. So that is why taxonomies play a very, very major role. It bridges and provides a long-term direction. Now, India is slightly different. We are not slightly, majorly different as a global south country. We have coal is a priority for India. If somebody says coal phase out, phase down, I think we have a challenge. 72% of electricity is coming from coal. We should be clear of that. And then coal, to convert coal gasification, coal liquefaction, all these things are happening. Government has given target 100 million ton coal gasification from underground mining. Government has given target. And we need to provide energy for all. Health for all, housing for all, road for all, schools for all. These cannot wait until 2070. They have to be done in next 2-3 years. If that has to be done, we cannot transit away from coal. I am very clear on that. And we can transit to make coal cleaner in the long run. Long run is 5 years, 10 years. But we definitely cannot move away. So power has to be provided. Coal India, CIL, if you read their chairman, CMD has said that coal 1 billion to 1.5 billion by 2032, we need it. It doesn't mean that we are not going with renewable. We are going. We have a target for 500 gigawatt of renewable power by 2030. So India as a country, we need both. And that is the challenge. We need to grow and we need to grow cleanly. So both these challenges, no other big country in the world will have these challenges.
So if I might just, what I'm taking away from what you said is that there needs to, while there is a vision, there needs to be a breakdown of that vision into some form of a national plan, somewhat similar to what you described, Sean, that the committee did in the UK. I also sensed in what you said, the policies that we are putting in place, are they adding up, including the point you made about coal and the need for coal? I might add one more thing to that as a challenge or a gap, which is whether we are taking a long-term enough view of the policies that we are putting in place, because like you said, this is not an app that can be put in place and changed in an agile manner in 3 months. This is a plant that comes into place over 5 years or 3 years and then lives for 30, right? So there needs to be stability in policy. Just an example of this is CCTS, the carbon trading scheme that we are putting in place, which has no indication of the nature of pricing for carbon that we would be aiming for, right? In the absence of which, it's really hard to make investments. So I do see the gaps that exist in some of your recommendations. Maybe briefly, 2 things I'll ask you. One is, what are the 2-3 main recommendations that you have, and what will it take for companies to adopt those?
Yeah. So first thing is, as I said, coal is a reality, MSMEs are a reality, nuclear is going to be reality, bioenergy is a reality. So global taxonomies do not give proper level. Of course, coal has to be there. Then disclosures, climate risks have to be disclosed as a mandatory thing, because companies are investing, investors are coming. So you have to tell very, very transparently that where are you investing. Now, for example, banks have to see their portfolio and profile. What are the risks in their profiles? Are they investing in coal companies? Are they investing in clean companies? So those things have to be there. And I think the word is harmonization, not synchronization, not alignment, harmonization, because Indian BRSR has been released already, it is being implemented. We can harmonize it with like CNFD, with ISSB, all these are important and good, but let us not get forced in that I am a global player and please do whatever I am saying. That is not possible in today's world. So we should harmonize our BSR. There are gaps in BRSR also. So we need to see that. 140 indicators, in my very, very honest opinion, more than 40 may not be required, in my opinion. Right. And then sectorally, every sector 5. That's all. So 40 plus 5. Otherwise, it becomes a mundane exercise. People say, hire somebody and do it. It doesn't go to the C-suite. It has to go to the C-suite. Thank you.
Good, excellent. Thank you very much. Maybe let me shift to one other topic, right? We've talked about disclosures. Let's also talk about a topic which has been a significant part of the discussion of the CII Sustainability Task Force. And maybe, Sean, you spent a bit of time telling us about what the UK Green Investment Bank did. Rajneeshji, if I might turn to you, given our challenges, what form of a green financing institution would you recommend?
So it has to be different than what the commercial banks do, what NAFID does, what REC does, what PFC does, and what IREDA does. So it has to be very different. And my thoughts, which I gave in the task force also, was this institution its job would be to build capacity. We don't have enough capacity to even appraise the projects, enough number of professionals even. So what happens is that if NABFID needs manpower, it will not take from State Bank of India. So that's not the way. We need at least in this country 300-400 high quality professionals who know how to appraise the projects if we are talking about this scale for green finance. This institution, its job should be to assess the risk properly. Not like a commercial banker. Commercial bankers' skills have always been in assessing the working capital finance. The State Bank did try because that was a responsibility which fell on its shoulders, that if a State Bank doesn't, then who does it? But otherwise, if we have an institution which has professionals who understand risk and prepare a package, appraisal, takes the risk, participation. Funding is, again, I'm saying, not an issue as well. There's an issue around for commercial banks asset liability management. And when we talk about reducing the cost of funding, one key element is the high risk premium. So if we can evaluate risk and mitigate risk, then obviously that cost can be brought down. So end cost will be lower. This institution should have a think tank. So I am not envisaging just a cat copy of any other financing institution. And obviously it should be a conduit for mobilizing international capital, transition financing, not in rupee, but in international currency. Obviously, then its jurisdiction can be now we have gift city, so it need not be outside the gift city, so it can do that role well. Preferably, it should be out of government control. I have used the word preferably because for institution to get credibility, the government ownership makes a lot of difference. There are upside and there is a downside with the government ownership. The upside is that institutions gets credibility. Downside is that there are too many controls and it loses its freedom, it loses its professionalism. So there are a lot of issues around when it is under government control. So can we have an institution which has government support but not ownership? And supported by multilateral institutions, supported by banks, supported by all the institutions which have in country. It should be a repository of all the green projects in the country. So can we think of some sort of a registry where if the taxonomy, green taxonomy is there, then there is no sort of no idea that how many green projects across the country are going on. And particularly when large industrial houses, they announce that we will go for hydrogen, we will go for 30,000 megawatt capacity renewal, that you know. But there may be 1 megawatt, 2 megawatt, 10 megawatt, many projects, CBG projects. They all are going, where is that repository? There is, I don't think it is being done. It can be done by this institution, it can be done by, we have that Udyami number. So whatever way, but we have to find a way. And we need a planning that how much capital is needed. And so this institution, in my view, has to be very different. But definitely in our country where the requirement and the goals and the scale is so massive, the energy requirement, which is, I think, the energy is the main thing around the net zero target, and Amit spoke about all this dependence on coal. So if the task is massive and we will have to do prioritization, again I'm saying the large industries, they can mobilize capital on their own, they have that strength. But what we need is the more democratization of this distribution of capital. And for doing that, this institution, in my view, it should be created and it should be created with a clear mandate. It should not be a copycat of all the institutions which are currently working.
Understand. Understand. Maybe I do have one or two more questions left, but let me just first open it up to the floor and see if there are any questions from the audience here. Yes, ma'am. Please give your name and keep the question short. Use my microphone.
Thank you. I think I was hearing the discussion which Rajneesh was talking about, and my name is Sonia, and I'm from HP. I'm the Renew manager there, Renew category manager. So I think, Rajneesh, when you were talking about creating the democratization of the ecosystem, and that's where the change is going to come. I feel that the question I have is, IT plays nowadays a very important role. And if IT is going into every house, every person, and the penetration is so high, then the disposal of these devices, if not handled properly, and if it is in the hands of...
Your question is about e-waste, ma'am?
Basically on the ecosystem again. Because here I'm talking about the ecosystem, democratization. That it should be a part of the taxonomy. There has to be not the norms which are there for some people.
Let me see if there's any reaction to that. That sounds to me more like a comment than a question, but...
Yeah, there are, I agree with you, but there are rules already on waste management. Government is also coming up with e-waste management. So maybe they will take some time to be followed by the industry. But rules are there to the best of my knowledge.
I fully agree here. My question
I'm going to have to take another question if you don't mind.
We can discuss off.
Sure.
Yes, sir, please. And then I'll go to the back too. One more I'll take for sure.
Can I have one?
Can you pass the microphone? I'm sorry.
I have a question.
Okay, ask quickly.
Yeah.
And
So
then
my question is to Professor Garg. So this is around the taxonomy and climate fund. So the other countries or developed countries, how they have used taxonomy to generate climate fund, and is there a way forward for India around the taxonomy and climate fund?
Just hold on, Amit. Let me just get one or two questions together and then... Okay, can somebody give a microphone here? So your questions is climate funding through taxonomy. Yes, sir.
Rajat, fantastic session so far. Learned a lot from it. I want to double click on Rajneeshji's idea of this new institution. Two thoughts. One is, can we have the capital come in from the single stock risk reduction that most promoters in India are today doing? If the capital gain from that could be protected to fund this institution, is a thought that came up while you were talking. The other thought is that there are so many institutions which are now creating the capacity. Can somebody at a central level bring all of this together and create the bridge from the theory to the practice, which is what is lacking, from ambition to action? That's what might be required.
Sure. I'll take your question.
Thank you. Shailesh is like veteran,
Yes, of course.
Thank you for the insights on being cost conscious as well as carbon conscious. So my question is to Sean, that how international climate finance, or let's say blended finance, can help bridge India's capital gap in accelerating net zero while having a stronger priority on hard to abate sectors decarbonization. So that's my question.
Thank you. Okay, I'm going to take these three questions for a moment. Okay, go for it.
This is for Mr. Kumar. You talked about solar power, for example, and I have some practical experience on that. We started at 14 rupees and we are at 2.5 rupees. Now, there are three things that happened. One was, previously we were getting panels from Russia, from China. There was a monopoly. When it started coming up, we were getting from America. The second was the scale. And third was awareness. Now, there is a period in which people need support. Today, the solar power doesn't. how do you divide, how do you manage the developmental stage of a new technology? Are there ways by which the government support can be one? But from a financial institution point of view, can there be something, because when an idea is still at a nascent stage, how do you support it? And you take a limited period, because once it reaches scale, and we've seen that in various other things, electric vehicles, I've seen it also. Thank you.
Okay, thank you. Maybe we'll start with your response to the first question around.
Yeah, I think if you see, taxonomy draft has been released by Ministry of Finance, Department of Economic Affairs. So climate finance, they are supposed to be. Of course, we need to do a lot of harmonization. RBI is coming out, I understand, with some guidelines or to banks. SEBI has done so, BRSR, and Ministry of Finance is giving taxonomy. So I think these three have to be aligned. We are a big country, and there may be some gaps, but it will be filled up. I am very sure we are talking to each. This ISTF committee is going to talk to each. We have spoken to many. I think there is a positivity in the market. Everything will not happen in day one or day zero. It may take 1 year, 2 years, but it will be aligned, harmonized in a way. Thank you.
Sean, do you want to take the question?
Blended finance.
Blended finance?
Yeah, just to remind everyone of the question, is there a role for blended finance to bridge the financing gap here in India? And so let me give you a nuanced answer to that. The short answer is I think it is necessary at the moment. But there's a longer, more nuanced answer which I think is important. There's two types of blended finance. There's some form of guarantee that guarantees a first loss. So for foreign direct investors coming into India, if something goes wrong, that they get their money back. That's one form of blended finance. Another is where that tranche of blended finance has a capped return. So it only makes a modest return on capital, leaving the rest of those returns for the other investors, i.e. it enhances the return, in theory, to deal with the additional risk. Given the size of the financing gap, particularly for equity, as we discussed earlier on, I think it's helpful at the moment to try and find a line of blended finance. But I would discourage you from thinking about that as a long-term solution. Governments don't have money and DFIs don't have money to bridge all of that. We have to show that returns in hard-to-abate areas and renewable energy, investing directly into India, is a very profitable thing to do. Now, to get people to make that initial leap, to put money at risk, to get experience of coming here and doing business, having a line of blended finance, either a first loss piece, which is kind of, I think, the better of the two versions, is important. But after you've invested that money, after you've got the returns from that fund, you need to show that you would have made an appropriate risk-adjusted return without that piece, so that when you go to raise it the next time, you don't need it. You have the track record and you have the evidence to show those foreign direct investors. If forever we depend on blended finance, we will run out of that money and the foreign direct investors that you need so much will disappear. So short answer is we will need some at the beginning, but we shouldn't get hooked on it. It is not a silver bullet.
Thank you. Rajneesh ji, two questions for you were around capital from single stock risk reduction, which I didn't understand. And the question, so it'd be helpful.
That I also did not understand, only Mr. Haribhakti.
And the question also, so I'd love to first understand the question. The second question also about the period of support.
Yeah, so about the support, the question ultimately is who pays for it. That is the question. So you either pay as a consumer or you pay as a taxpayer. Government doesn't have money of its own. What government is doing? It is an intermediary. Like a bank, it is also an intermediary. It has the power to collect the tax and then channelize it. So when, say, we took the example of solar power, when it was 14 rupees, it is the state of Gujarat, which said that we will buy that power. Only government could have done it, nobody else. So when there is a situation like this, only government can help. Consumer cannot pay for it. Biggest example is solar, we sorted out. Gas-based power plant, we have not been able to sort out. We invested more than 1 trillion rupees in creating 20,000 megawatt of gas-based power plant. And most of them, probably 90% of them, are still lying idle. There have been committees, everybody has broken their head around it, and no solution we have been able to find. Because the question is all around who pays for it. Consumer can't pay 12 rupees for gas power if I am getting power for 4 rupees, so why will I pay? Tax, of course, I don't feel the pinch. I feel the pinch, but I am helpless. Yeah. In that sense, government says we will put this much tax on you, you will pay for it. And then only government can.
Yeah. No, I think the other thing that
there
I
is
also,
no other way. Yeah, but in development stage, yes. Yeah. If that decision of buying power at 12 rupees was not taken,
the 2.5 wouldn't have happened.
Yeah.
Yeah. I might say that the closer we get to market mechanisms on some of those things, we talked about CFDs, the contract for difference, as an opportunity, the reverse bid mechanism that SECI uses now, which was a part of the solar mission originally established. I think the closer we get to market mechanisms on these non-market type actions, I think the better it'll be. And of course, the funding sources will be different, right? It'll be blending mandates, that'll be a source of funding, or it could be financial institutions, or it could be government, that could be sources of funding. Do we want to clarify the question?
Sir,
if you can ask your question again.
The idea is very simple. DG, you know it. So much capital gain is being recorded today.
Yeah.
Because people are selling off big chunks of their equity. If that capital gain can be protected by investing in your new green bank, that would become a somewhat easier way of
doing
funding.
it. That's a good suggestion to the government, and we can definitely.
Thank you. Thank you for that. Maybe I'm just going to bring this to a close in a minute, but Sean, I'd love to hear from you the story of what is perhaps one of the largest green climate startups in the world from a funding perspective, which is Stegra, or H2 Green Steel as it used to be called. So tell us a bit about where that came from, how has it got funded to the extent of 5 billion, still being in the hand of a group of entrepreneurs and private equity.
Yeah, so the project you're referring to is a project we invested in to produce green steel at scale up in Sweden. Originally called H2 Green Steel, very descriptive, but now called Stegra, which is Swedish for arise. In 2023, when we funded this was the largest private transaction done in the world. It was 6.5 billion euros in total. And we are building from scratch a steel plant which will run on hydrogen. This is quite extraordinary. Today we are about 50% built. We have 4,000 people working just short of the Arctic Circle. If you visit in the summer, it's -30 in the winter. It's very, very cold. And the idea was to come and bring together hydrogen as a source. Up in the north of Sweden, the grid is 98% decarbonized due to hydro at scale and wind. Take that low cost, readily available green power, convert it into hydrogen, and use the hydrogen to produce green iron. Now, I'm going to give you a very short chemistry lesson. I will take no questions afterwards. But if you have iron ore and you use hydrogen to knock off the oxygen, you get water. If you use coal, as you do typically in a blast furnace, you get CO2. So by using hydrogen, you can decarbonize this process, not by 10%, not by 20%, not by 30%, but by 90 to 95%. Now, the production of green hydrogen is a little bit more expensive, and it results in a price for that steel of about 25 to 30% more than ordinary grey steel. So there is a green premium for sure. And so in order to get the project financing in place, and the scale of this package is huge, this is 4.5 billion euros, we had to break the traditional purchase program for steel. If you buy steel, you typically work with someone and you may have a 1 year or a 2 year rolling order. I cannot borrow 10-year money with a 2 year order book. So we went out and we sold half of the output on 7-year contracts to people who wanted that green steel and were already paying for it. These are folks like BMW, these are folks like Scania, the truck company, these are folks like Microsoft, who is building data centers and racking systems. And whenever you buy an electric car, not only do you want 0% tailpipe emissions, you want as low an embedded carbon in that car as possible. So today, they go out and they build a car, and then they buy carbon offsets to decarbonize the steel in the car, which is about 60% of the weight. If I can buy green steel and pay a modest premium, which will only add $600 or $700 to the price of a $40,000 car, and I'm already paying some of that, it's very possible. So we arranged the forward sale. The scale of this is huge. We forward sold about 30 billion euros of green steel. We've then organized the project financing around that, and we raised an additional 2 billion equity. It's exactly the challenging stuff that allowed us to put 6.5 billion euros in place and to kick off the plant. We are halfway built. We will have first steel coils coming out Q1 27. We're very, very close to that point. And then what we want to do is show that this is an asset class. Let me give you one example of something else that's been done like this. When we started investing in the Green Investment Bank in offshore wind, it was very, very expensive. It cost 3 times the price of conventional power in the UK. But over a period of 7 years, we financed about 10 projects. The market built an additional 10 projects. We delivered those broadly on track and on budget. And through turning that in from a cottage industry, a very big one, into a proper industrialized process, we took the premium from 300% to minus 20%. Offshore wind became cheaper than conventional power, just like renewables here in India is cheaper than conventional power. And in doing so, we created a financing asset class. We were able to take all those projects that everyone thought were crazy when we started them, package them up, put them in a fund, and raise private capital into that fund. So we took government money, took a commercial risk, built the projects, recycled the capital, came down the cost curve, and created an asset class for pension funds to go into directly. We now need to do that in steel, cement, chemicals, plastics, EVs, and a whole host of other things. And that's what we do at Just Climate. Because, as I said earlier, governments don't have enough money. The natural progression after you build a green financing institution, which is government money, is to tap the deeper pools of institutional capital to do exactly the same thing. That's what we do at Just Climate.
Wonderful. Thank you for that. Maybe I'll use that to bring this to a close. Very difficult to synthesize the discussion, but at least my takeaways, I think starting with what Rajneeshji said, is that equity is the problem, debt is not. But yet, I think in the course of the discussion, it also became clear that for some of these so-called infra-venture or venture infra projects, which are early stage, debt also becomes a problem. And also we saw some solutions that were talked about in the course of this discussion. So I think that's one takeaway that I do have. The second one is that there is an extraordinary role of policy, strategy, long-term thinking, which you translated in the form of plans, 5-year plans, taxonomy that needs to be put in place, all of those things that have to be in place for these to work. The third takeaway is that it is a huge capability issue of assessing these projects in the right way and matching the providers of capital with the creators of the projects. And Rajneeshji talked about a potential solution for that. And then the last one is really around the right appropriate project creation, right? Particularly when it's early stage in this infra VC type mode. And then support them in the right way and with the right sets of instruments, some of which you talked about, Sean. So with that, let me bring this to a close. Thank you all for listening in patiently, and thank you to the panel for.
Thank you to all our panelists. I request you to step forward for a group photograph. And before we conclude, a request to Mr. Gupta to present a token of appreciation to our speakers, Mr. Kingsbury, Mr. Kumar, and Professor Garg. And I'll request Shikhar Jain, Executive Director, Center of Excellence for Sustainable Development, to present a token of appreciation to Mr. Gupta on behalf of CII. Thank you. Up next in this hall, we have a session on building resilience, supply chains for a changing world.